this follow-on module to the section devoted to goodwill and negative goodwill, we will be exploring a number of worked examples with the aim of putting together a comprehensive framework for solving F7 exam consolidation questions. This will be especially valuable and crucial to those of you who received an exemption from the F3 financial accounting paper and did not therefore have an opportunity to get yourselves acquainted with the recommended approach to tackling these problems. In contrast to the previous module, we will not be utilizing T accounts, but rather, for the sake of speed, follow a tabular format to derive the most crucial items which you will be required to calculate on the exam. Let us start with the most basic of examples and then subsequently build from there by introducing more complicated items and circumstances. So, example 1 reads, P acquired the entire share capital of S for €8,000 on the 1st of January 2017, when the statements of financial position of the two entities were as follows. And our job is to prepare a consolidated statement of a financial position as at the acquisition date. The first working which I would like you to get used to pertains to group structure, although in fairness, in this case it will not necessarily be too revealing, seeing as P owns 100% of S as at the 1st of January 2017. It must be stressed, however, that in more complicated scenarios, which you will no doubt encounter in the F7 exam, the group structure working will help you get the relevant percentage ownership proportions right, which are crucial from the point of view of attributing retained earnings and other reserved capital to various groups of shareholders, as well as properly accounting for goodwill. The second working which we are going to need is called subsidiary net assets. On the left-hand side, I'm going to list the two lines that make up the net assets or equity of S, and that's share capital and retained earnings. This table is going to feature 3 data columns, which we will label acquisition date, consolidation date, and post-acquisition. Because in this example, the acquisition and consolidation date are one and the same, we will enter identical numbers in both the acquisition date and consolidation date columns. So that's 5,000 in respect of share capital and 3,000 for retained earnings. The third column, post-acquisition, is used to compute any movements in reserve capital, that is, retained earnings, and if applicable, revaluation surplus between the date of acquisition and the date of consolidation. Seeing as share capital is not of interest to us in this column, we may put a horizontal line there. There is obviously no difference in the balance of retained earnings, meaning that no retained earnings have yet been generated in the subsidiary since the acquisition. Before we move on, it is important to stress that the net asset numbers which we input into this table should reflect fair values as opposed to book values taken simply from the subsidiary's statement of financial position. As you will see in later examples, whenever those two values differ, appropriate adjustments will need to be made to reflect this fact. The third working is called goodwill, and I encourage you to think of this one as the equivalent of the cost of control account, which you saw me use in the introductory video of this section. The computation of goodwill starts with the investment made by the parent to acquire its stake in the subsidiary, and in this case, that's the €8,000 taken from the parent's standalone statement of financial position. From this, we deduct the fair value of the subsidiary's net assets as at the date of acquisition, which may naturally be taken as the €8,000 total of the acquisition date column from working 2. Seeing as the subtraction yields a result of 0, we concluded that there is, in fact, no goodwill arising on this transaction. The fourth working is going to be called non-controlling interest, and it will only be relevant in those cases when the parent entity owns less than 100% of the subsidiary being consolidated. Now, even though that is not the case in this example, you may be pretty sure that it will be the case in your F7 exam, so I want us to write that name down so as to get used to the structure of these workings in their entirety. And finally, working number 5, which we will use to derive the group retained earnings figure. This kicks off with the entire retained earnings of the parent, giving 12,000, to which we add the parent's share of retained earnings generated by the subsidiary since the acquisition. Recall that as part of working 2, we already identified this number to be 0, which leaves us with a group retained earnings total of €12,000. Working 5 is the last of the standard computations, which we will be utilizing throughout the examples, and we are now ready to put together the consolidated statement of a financial position as at the 1st of January, the date of acquisition. As you will surely recall from the previous module, the investment in S line is dropped altogether from the group statement of financial position, so we begin with other assets, which are simply the sum of the two numbers coming from the books of P and S. So that's 13,000 and 10,000, giving €23,000. In light of the fact that there was no goodwill generated upon the transaction, that result is also the figure for total assets. Moving on to the equity section, as we previously stressed, the share capital of the group is always the same as the share capital of the parent, so €6,000. The group retained earnings total derived in working 5 was €12,000, giving an overall consolidated equity balance of 18,000. Group liabilities are simply the sum of the relevant P and S numbers, producing €5,000, which brings the balance of consolidated equity and liabilities to 23,000.